All right, cool. So we are officially recording. Guys, I'm super excited. We're about to talk about strikes. We're going to talk about liquidity, and we are going to talk about our grief. This is the lesson more than any of the other lessons that I've taught that I've been most excited for, and I need you to do two things for me before we get started. Number one, get yourself a pen, get yourself some paper. I'm gonna give you a second because we still got a minute before we get started, but you need to be writing things down this time. Also, another thing, the final thing I need from you is to ask a question because I get on a roll when I start talking about this stuff. And if I leave you in the dust, that's not good. I want to make sure that I'm bringing everybody along with me for this. So if I use a term or if I'm talking about something and you're like, this is over my head, tell me to slow down. Tell me to break it down for you. There's more than one way to skin a cat, right? So we want to make sure that everybody gets it. I need you to come out of this lesson with more clarity than you had when you came in, all right? So with that being said, we are going to talk briefly about strikes, right? Strikes, and why they matter. So, you know, from our first lesson when we discussed what strikes were, what their purpose is, that we use strikes to determine the price point at which we are going to pick up our shares, correct? If you remember what I'm talking about, drop a one in the chat for me, if that makes sense. We use our strikes to determine the price that we wish to buy shares of stock at. Perfect. So, the thing about it though is that not all strikes are weighed equally in the trading world. There are some strikes that are better to choose than others. Is this always the case? Not necessarily. There are times when a stock is so liquid that you'll be able to get away with it, or an ETF, for example, SPY, right? The S&P 500's mini ETF. It's so liquid that you can choose a crazy strike and still come away with plenty of money, do what you need to do, in and out, bada boom, bada bing. But that's not always the case with everybody, right? So let's actually talk about what we should be looking for whenever we are looking for strikes to trade. So let me pull up, I'm going to use, no, let's start off with actually using Amazon for a second. So one thing that you're going to notice is that each of these strikes actually end in a multiple of 10, or they end in a 5. In my experience, and I'm not going to sit here and act like I'm the most experienced trader of all time. You can see all my positions right there. um, I have found that it's like when you look at the strikes that are multiples of 10 or strikes that end in 5, you're going to find that there's more activity there. So what do I mean? All right, here we go. So let's pull up two different contracts. So first and foremost, when you get closer to the money, you're going to find that there's already more activity that's happening here, right? So the volume on this today was 3,010. Open interest on this is 784. We'll get into volume and open interest in just a second, but I want you to see this. At the round 100, the volume is 15,097. Open interest is 8,586. So you can see that this at the money contract that into the strike that's got a 5 on it, there's some volume, there's a little open interest, but at the whole round 100 and at every whole round 100, you're going to notice that there's a tremendously large amount of volume and open interest typically sitting there. Why is that the case? All things in the market have these things called psychological levels. People like balance. People enjoy balance. Whole round numbers have a tendency, people are more likely to want to buy shares at $25 than they are to want to buy them, or actually, how should I say it? They're more likely to put an order in to buy shares at $25 than they would be to put an order in to buy shares at $24.75. Even though one is a better deal, it's just psychologically people want that whole balanced round number easy, gravitate towards it. So what you'll notice is during a trading day, a stock may be close to a psychological level, right? It might be, oh, let's see, I don't know, off the top of my head, Shopify. Let's see what they're up to. Shopify. Wow, okay. Prime, literally, I could not have made up a better example if I tried. So right here, what do we see? This is $13.99 after hours. We are $1 away from $1,400. That didn't happen by accident. This little 3-cent jump that it took right at the end to make it nice and round, that's not an accident. Tomorrow, this thing is probably going to, let's see what it's been doing over the week. It's probably going to continue trending up a little bit, and it's going to get into the 1400s, and it may even use 1400 as a support level, right, where people are going to be buying in. Why do I say that it's going to use it as a support level? You're like, Hunter, price action has been sitting below 1400 for the longest. Yes, it has. But what's going to happen is people are going to want to buy it at that level. Once it gets up above it, people are going to say, well, 1400 is a pretty good psychological level. I'm going to go in here and I'm going to go ahead and buy. So now we've created a floor. We've created ourselves a floor here. We can see that price action has already been up above it. I bet you, let's see, shop. Oh, of course, I hit a typo. Annoying. Shop. What is going on with my computer right now? Shop. Good Lord. Here we go. All right. Enough of the hullabaloo. I bet you, no, it looks like there's no gaps. It filled up all of its, no, it didn't. No, it didn't. Sure enough, there's a gap right here in the chart, meaning that that gap is probably going to get filled pretty soon. And we're looking at a 4 hour. Let's see what it looks like on the daily just to confirm. Oh, actually, yeah, that gap might have been filled. It looks like it was filled, actually. So yeah, actually, I guess we don't have a gap still. It already did its thing. It came back up that wick right here up to 1429. Yeah, it filled the gap. So right now, price action paused, and look at where it paused. Boom. This is on the daily. The 20 simple moving average on the daily. That's not a coincidence. Price action on Shopify is where it should be relative to where price action would be, all candles weighed equally, the last 20, I should say, on the month. That's not a coincidence. And what's going to happen is it's going to use this 20-day moving average as a support level. Notice that it's using the EMAs here as a support down low at the bottom of the candle. At the top of the candle, it closed because the 20 MA pushed it down some. Can you guys see that? Drop a 2 in the chat if you can see what I'm talking about. Drop a 3 in the chat if you're confused about what I'm saying so far. Okay. I see some 2s coming in. Okay. No 3s so far. All right, cool. So, right, we got all that situated. We're looking good here. So psychological levels are vitally important, and I personally do all of my trading based off of psychological levels. So, for example, going back to what we were looking at with Amazon earlier, right? You can see that the strikes that I've chosen, the 3,300, right? I sold to open the 3,300 expiring this week. Well, that's actually part of a calendar spread. So I bought to open the 3,300 Amazon for next week as well. At the same time, this price offsets it. But you can see, right, I sold to open 3 more of the 3,305. So what I'm saying is that by Friday, I don't think that we're trading above $3,305. And I bought to open the 3,310. So these that I sold to open, I got paid $1,133 per contract, or $3,399 or whatever it is, while at the same time I paid out $975 for each contract. So I used these contracts to pay for me buying this one, and I ultimately ended up collecting about $140 per spread. So I have 3 of them. So that should be, do the math, right? Easy money, little money, something that just tied me over. So psychological levels are vitally important, and essentially it's not necessarily a hedge per se, but it's just understanding market psychology. So like if you understand that there's a tendency to gravitate especially towards whole round numbers, multiples of 10, and strikes that end in 5, you'll be left off in a very good situation. Now, let's talk about liquidity though, because now we can start getting into the nitty gritty, and I love using Kroger as an example. Do they have any of those funky strikes? They don't really, but they have a couple. So we're looking at the same thing, right? This is Kroger, and let's actually go back to the front and let's talk about liquidity first from a stock perspective before we get into it from a actual, oh, here we go. Yeah, from an option perspective. So as you can see on my screen here, you can see that we have the volume. I'm going to highlight it right here. And then we also have average volume right here, right? 6.92 million with a volume today of 4.6 million. So let's talk about these two things before we get into the nitty gritty. So what is volume? Volume is the number of shares that were exchanged on a given day during a trading period. So from opening bell to closing bell, that is going to tell you what the volume is in the stock. It resets to zero every single day because it's a brand new day. There's no volume. You can't count yesterday's volume and today's volume. Pretty straightforward, right? Anytime that there's shares being, this is for shares, right, being bought and sold, that volume number is going to increase, okay? The average volume is taking the average of each of those days' volume over the course of like a certain time period, so usually like a month. And what you see is the average volume on each day. So if the volume on the day, that particular day, is lower than the average volume, you're typically not going to see tremendous, ridiculous moves in the stock, typically. When you start seeing, let me see, what did BBIG do today? I'm trying to think. I should have found some tickers that were actually doing something. So it was up. Okay. Volume is 59. Oh, here we go. Perfect. So when you see that the volume on the day, right, 59.11 million versus the average volume, 30.76 million, you'll typically see a large move. And today, even though the move was only 42 cents, that's almost a it is a 6%, almost 7% move on the day. That's tremendous. Stocks typically don't move about 7%. To give you an idea, Amazon went up $30 today, and I only think that was like a 0.5% move or 1/4% move. And then it proceeded after hours to move up another 1.32%. So all in all today, we went up almost 750, 80, 789, 7.89% today. That's ridiculous, right? That's a really strong, healthy move. Let me think of something that probably didn't get such a good. I can't think of anything off the top of my head. Realty. Let's see what realty income is doing. Okay, they went up a little bit. Let's see what their volume looks like. So today, they actually have more volume than usual. Interesting. What could I use? Oh, duh. Why? I don't think they went with their normal volume today. Let's see. Yeah, today's volume. Oh, perfect. Today's volume was 72 million. Average volume is 99 million, right? So banks are doing pretty good. But this is an example, right? So less shares were traded than usual. There's a low volume day in the market overall. That was because people were afraid because Jerome Powell and the Fed were talking about tapering. They used the T word. Everybody gets freaked out when they use the T word. So everything was kind of slipping a little bit. And then 30 minutes before he started talking, we ran up. We started to flag a little bit. And then we ran up some more. And then we kind of chopped all the way into power hour, all the way through the rest of the market open. All right. So we have now officially discussed stock liquidity, right? Liquidity for stock refers to the amount of shares that are being traded. Let's see, small cap. Let's see. Give me, somebody drop a ticker of a small cap company that they know of that we can look at. Because I want to be able to discuss something that's illiquid. Oh, we could use BEST. Perfect. BEST. All right, perfect. Nokia is a little more popular, so we'll talk about that one later on if we have some time. All right, check this out. The volume today was 1.65 million. Average volume is 4.08 million. So we were trading at 1/4 of the average volume typically, right? So that's pretty low already straight out the gate. And this is trading at 1.88, right? Its market cap is not all that big, so we know, what is the market cap? Where is it? Market cap is 729.77 million. It's actually a little bit bigger than I thought it was. They must have hella float. But anyways, so we look and we say, okay, what can we do with this? So this is the options chain. This is the entirety of the options chain. Strikes that end in 5, right? So we have 0 in volume, meaning we'll talk about stock liquidity in just a moment, but meaning no contracts were exchanged on the day today. 3,176 in open interest. This contract at 2.5 has 14,309 in open interest and 48 in volume. And the reason why this has more uh, liquidity, or it's more liquid than the $5 strike, is simply because this is a stock that's only $1.88. The probability that it shoots up to $5 is dramatically low because it would take a huge influx of cash to get us there. But 2.5 isn't out of the, I mean, it's still pretty wild, but it's not out of the ballpark, right? And then if we look at this 7.5, it's even less probability, right? So there's only 671 in open interest. And if we wanted to, we could take the time and spread it out some, but it's the same idea. The more time you put on it, though, the less activity that you'll find. Let's use one more. Let's use JAKK. Jack. All right, let's see what they got. $12.60. Okay, just barely out of. Oh, this is perfect. This is perfect. Jonathan, you're great. So the market cap is 124 million, right? So about 1/7 the size of the company that we just looked at. Volume today was only 717,000, or no, excuse me, 771,000 in volume, but the average volume is 126. So there was more volume today than the average. In fact, it beats it out almost like 5.5 times. So that's pretty good. But let's see. Oh, you can't even trade options on them. So that's a little tough. Well, let's go back to Kroger. All right, so now we're going to talk about option liquidity. So we talked about stock liquidity, right? And one of the things that I mentioned in the Instagram call that I gave earlier, for those of you who missed it, is that there is a tie from stock liquidity to option liquidity as well, right? Like those things go hand in hand. So what do I mean by that? Well, when a stock is very liquid, when there's lots of volume on the day, and the average volume, is also quite large, right? So there isn't a specific number because I know somebody's gonna be like, well, what's the exact number? I'm always looking at large cap stocks, so I'm less concerned with micros. But I mean, bare minimum, think about it. There's billions of people, or I should say, hundreds of millions of people that are trading stocks every single day, right? So for your ticker to have less than 1 or 2 million in volume on the day is pretty bad, all things considered. Like if there's 100 million people that are on our stock market trading at any given day, any given moment, and not counting bots as well, and you're only getting 1 million in volume or 2 million in volume, that's kind of low. Average volume, I should say. If your average volume is only 1 or 2 million, that's pretty rough. But like Amazon gets like 1 million to 3 million in volume on the day. So yeah, it all just depends. But for me and my trading, I like to look for large companies that have lots of shares exchanged, millions, hopefully. But like I said, stock liquidity, option liquidity, they go hand in hand, right? So how do we make sense of this? First thing we want to do is we want to look and we want to find our strike that fits our criteria, right? So 41, we talked about how when they end in the whole round numbers, they're going to have more volume, they're going to have more open interest. So let's talk about volume and open interest before we start comparing and contrasting. Volume, like stock volume, option volume is also a daily metric. It resets to zero at market open every single day, and it is telling you the number of times that this contract has been like bought and sold or exchanged on the day to day. There are people who use option volume in this thing called unusual options activity, which we can talk about for sure after everything is all said and done if you guys want to. But volume is a daily metric that resets to zero, and it is basically telling you the number of times it's been exchanged, that particular contract at that strike and that expiration date for whatever company it is. No matter how deep in the money it is, no matter how far out of the money it is, no matter what ticker it is, the market cap of the company, doesn't matter. Volume resets to zero at market open every day. So you're like, great, I can look at the volume and I can see who's really trading this contract up a lot, or if the contract isn't getting that much play. Yes, right? Yes, yes, yes. Next, though, that we use when we're looking at volume, because volume is not the only important thing for us to look at, we also look at this right here. It's called open interest, okay? So open interest, what it is and what it means. Open interest is basically the number of people holding this strike this expiration, this exact contract in their portfolio presently. Now, it's not guaranteed to be 8,857 people. It could be one person with 8,857 contracts. It could be 8,857 people with one contract or any derivative of those numbers. But what it is saying is that is the number of outstanding contracts right now existing. Now, the thing that makes open interest different from volume is that open interest does not reset to zero at market open every single day, okay? Open interest actually can only be manipulated one of two ways. Either someone sells to open, right? If something is sold to open, a new contract is sold to open, that's going to add one to the open interest. You're going to have a new open interest. But if somebody exercises the contract, right, or the contract expires or anything like that, that's going to subtract from the open interest. And open interest is also updated at market open as well from the previous day's activity. So right now, there might have been 2 or 3 people that exercised. They probably wouldn't want to because this is out of the money, but you never know, right? Somebody might have exercised, 2 contracts. So tomorrow at market open, this is going to be 88.55 rather than 88.57 because those 2 contracts have now been used up, right? Now they got the shares, they're doing what they wanted to do. So open interest is not a daily metric. It does not reset to zero at market open every day, and it's telling you, or it's indicative of who is holding this position currently in their portfolio. Now, what does this have to do with your bid and your ask, right? Remember we talked about the bid-ask spread? The more activity that you see, the more volume, the more open interest that you see on a particular position, that is going to create a tighter bid-ask spread. So if you guys remember earlier how I was talking about you can determine whether or not you're going to have a good spread versus a terrible spread based off of the volume and open interest on your contracts. This is because when there's a lot of volume and a lot of people are buying and selling those contracts, market makers are able to match up loads and loads and loads of orders. So they're making money off of the differential of this spread. So from that differential, they're able to collect, this is a 3-point spread. They make $3 for every one of these trades that came through. So multiply this number by 3. That's what market makers made today based off of just this strike. And there's hundreds of strikes, hundreds of expirations, and they're matching millions of orders every single day, every single moment, right? So that, if you use your volume and open interest, will help you tremendously when choosing your contracts. So we can talk about like time as well because that ties in with it, but I want to make sure I show you this example first. So you can see, right, this $40 call, multiple of 10, whole round 0, looks good, has a volume of 1157 and an open interest of 85 or 88.57, right? If we scroll one strike up, literally from 40 to 41, look at the volume, 2,046 versus 1,057, but the open interest, 3,377 versus 88.57. So the difference here, we can see more people traded this contract, but more people are holding this 40 because more people want to buy shares at 40 rather than 41. So you'll typically find that those strikes that are kind of wonky will have a weirder spread as well. But in this particular instance, since, the program moves so little, this contract is worth next to nothing anyway. So yeah, now let's talk about time a little bit before we get into the next example. So expiring November 12th. This is the same $40 contract, and this is the same 41 strike contract, but it's just at a different expiration. So you can see here, look at this. I go from this week to November 12th. The open interest is only 92. The volume is 1. And that was for the 40. For the 41, the volume is 0. The open interest is 221. So why, if you can give me a blurb, tell me why you think there's less volume and open interest on these contracts with an expiration that's further in the future. Give me your answer. What do you think? Why is that the case? Why do you think This is the notoriously liquid tickers I can think of. Decay, more premium, not quite, not quite. Theta, not quite theta. They cost more further in the future. This is also true. But the real reason why there's less activity there is because people aren't really trying to trade a month in the future like that for real. Most people, they're trying to figure out what's happening this week, what's happening today, right? They are not looking at the big picture. They don't necessarily want to get in on it long, 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 long term. There are some, right? And those people, maybe smart money and maybe people who are just entering into spreads. It could be anything. But for the most part, you're not going to feel the effects of implied volatility. You're not going to really feel much of anything unless the stock makes a move. So this is not going to make any sense right now, but at the end of this lecture, you'll understand. It's more dependent on delta to feel the effects of what's happening, not vega. You're not really losing that much money from theta. Your gamma ties in with your delta. And obviously, like rho is not really applicable in this situation. So that's why. It's because the volatility and the real price swings, when you see people that make a lot of money off of their plays, it's because their contract was a soon expiration. The more recent that the expiration is, the more the implied volatility will be felt if a large move happens in the stock. So let's see. Wow, they really cleaned up this options chain, man. I was looking for some crazy stuff and I can't even find it. But check this out. Here we go. So this is an example of something that I would consider to be relatively illiquid. Why? Well, the volume is 854 and the open interest is 943, Hunter, and it's at the whole round 100. Why are you saying it's illiquid? Because I'm looking at the bid-ask spread. So here we can see 1450 is your bid where the buyers are coming in, right? We know that the bid is where the buyers are, B for buyers, and the ask is where the sellers are. There's an S in ask, there's an S in sellers. That's how I remember it. Buyers want to buy things cheap, so the bid is the cheaper one. The ask is expensive because sellers want to make money. So when we're looking at this particular contract, right, we can see that the difference between the two is $150, right? So if we are looking at a $1,600 play and we take $150 out of it to be able to escape it quickly, we are going to incur a 9% drawdown to our account, right? Times 100, boom, 9.375. So for us to get out of this position quickly, we have to be willing to sacrifice 10% of our premium off rip. And that's if we're able to catch it at the bid instantly. And there's only one buyer. So remember, the open interest is 943. So if number 583 says, oh man, I got to sell too, there's only one person here that's going to be able to soak up that sell order, right? That's pretty unfortunate. So what's going to happen is the buyers will be able to take control. They'll say, yeah, I don't want to buy it at this price then. I'm going to try to, all of y'all are trying to sell it and get rid of it. When there's more sellers than there are buyers, prices decline. So it might drop down to 14, right? Now you're going to lose more than 10% of your entire profit or your trade just to exit. You might drop to 13.50, then 13, then 12. You see what I'm saying? So it's like a kind of a vicious cycle. If this makes sense to you, drop a 1 for me. If you're still confused, drop a 2 for me and ask your question. I want to make sure that I'm not leaving anybody behind on this, because I know I'm talking a lot, but this is worth understanding. It makes things a lot easier. This makes sense? 1 if you get it, 2 if you don't. Okay. All right. All right, cool. I see some ones in here. So good. So that's essentially what I want you to be able to understand about liquidity, right? Is that it is tied to you can check to see if you're in something that's liquid or not by looking at the bid-ask spread. If your spread is taking up, honestly, I don't even like to lose more than like 5%. But if your spread is taking up 10% or 20% or whatever, you just have to determine what you think is a good enough spread. There is no exact number that makes things perfect. But for me personally, when I'm doing, I'm looking at my spreads, I'm like, yo, this is kind of, this is super wild. I'm not going to take the trade, or this is great. I'm going to take it. So one last example before we get into the Greeks. Let's look at SPY real quick, something expiring this Friday at a whole round number. Let's use 435 since it's closest to where we're at right now. Volume is 100,983. So this contract was exchanged almost 101,000 times today. And the open interest is 26,300 or 238. Bada boom. Our bid ask spread here is 5 points, right? $5. So to see how much we'd be sacrificing if we really had to get out of it, literally what we're going to do is we're going to take our 5 points, we're going to divide that by our ask, right? So 222. So in this example, we're going to multiply that by 100. We come away with a 2.25% spread. That, to me, sounds pretty great. Liana, how do you calculate that? So what I'm doing is I'm taking the difference in between my bid and my ask, the spread, right? Bid ask spread, and I'm dividing that by the ask because I'm a seller. If I had bought this contract, right, I'm a seller. How much am I going to sacrifice? What percentage of my contract's value would I have to sacrifice by selling at this price at the bid? So I would put $5 over $222, and I come up with 0.02, whatever the heck the rest of those numbers were. Then I multiply that number by 100, and that gives me my percentage. Why did I get 5? What's the difference between 222 and 217? Bada boom, 5. So I take the difference between those two numbers, and then divide that by your ask, multiply it by 100. That's going to give you the percentage differential. Does that make sense? You don't have to do all this, by the way. I'm just giving you examples. This is not something, I'm not like physically calculating by hand. I'm at the point now where I can look at the bid, I can look at the ask and be like, okay, it's liquid or it's not. And I can look at the volume and the open interest and I can say, okay, this is a good trade or it's not, right? So full disclosure, this is just for an example. But yeah, so I'm looking at the spread. I'm like, okay, it's a nice spread. It's liquid. I'm good. I can get in it. I can feel confident, right? And you see, you're like, well, dang, Hunter, why is the volume so much greater than the open interest? Or is the volume, which one is more important, right? Volume or open interest? Please repeat the calculation example. Okay. All right. You don't need to know this. Full disclosure, I'm literally giving you an example about the calculation. You do not have to write this down. You don't have to know this. I don't use it. I'm just giving you an example. The bid where the buyers are is $217. The ask where the sellers are is $222. We are trying to figure out that if we were selling, how much value we would be sacrificing in order to get out quickly. Why? Because if, say, for example, this is SPY, but let's say we were trading Papa John's, right? This is a real life example. Papa John's went out, literally Papa John went out and was like, yeah, I don't like black people and I don't want them eating my pizza. So their stock obviously clearly took a huge hit because who would say something so stupid? Well, people who were in options trades who thought that Domino's Pizza was about to have a smash out, week because it was right around the time of the Super Bowl or whatever, they bought their calls. Well, what if they have to get out of those calls? There's only 32 spots at 217 for them to be able to sell it off, right? So they have to be able to sell at the bid because typically, right, if we were sitting here at the ask and we're waiting to be filled, we're order number 101, we have 100 people waiting in front of us to get filled before we can get filled. So we say, I'm not going to have a high probability of getting filled at the ask. I might need to go to the mark, right? So the mark is the midpoint in between your bid and your ask. So the mark doesn't work, right? Because the stock is starting to drop so rapidly. You have to go directly to the bid to sell. Because remember, bid is where the buyers are and buyers want to buy at a discount. Ask is where the sellers are and they want to sell at the most profit as possible. Your mark is the midpoint, the kumbaya, come to Jesus in between those two. So what do? You have to sell at the bid. So what I'm doing to calculate is I'm saying, okay, as a seller, I'm sitting here, I'm wanting to get 222, right? But the bid is 217. How much of my actual profits am I going to have to sacrifice in order for me to be able to exit this trade? All right. So mind you, The mark is the same thing as the current price of the contract. So in theory, I guess you could even say that the bid ask spread is even tighter, but this isn't the ask, right? This is the mark. So technically it's going to show that you have $220 worth of value on this contract, but I'm going from the perspective of a seller taking 222, just trying to sell at the best possible price. So I get the difference between your bid and your ask, and it's $5. There's $5 difference between 217 and 222. After I get that $5 difference, I'm dividing that by the ask because I'm dividing that from the profits that I would have been able to take away. You could also divide it by 220 if you really wanted to. You're going to come up with relatively the same thing because the ask is pretty close to the mark typically. They're equidistant. Then you're going to come up with a decimal number. It's going to be a big old long decimal number. You're going to multiply that by 100 because it's a percentage. That gave me like 2 or 3%. So that means that the spread, I'm only losing like 3% of my profits or whatever. I'm willing to cut ties with 3% if it means that I can get out when I need to. That right there is understanding bid-ask spreads, liquidity, getting into and getting out of positions. Does that make sense? I know it was a lot. It was actually a whole lot, but that's what I'm doing. Anytime that you hear me talking about liquidity or I'm talking about the bid-ask spread, this is what I'm looking at. My bid, my ask, my mark, my volume, my open interest. And so one thing, the last thing that I want to talk to you guys about for volume and open interest, because I know somebody has the question and they just haven't asked it yet. And so what about when volume is higher than open interest, or which one takes priority, or which one is more important? When you see that the volume is extremely giant relative to the open interest, right? Like if you saw that the volume was trading at 3 times, 4 times the open interest, that means that the stock is making a big move today. It's moving. People are finding value in this contract. It's in high demand. People are buying and selling it over and over and over again. Don't believe me? Previous close was 217, right? And the mark right now is 220. You say there was all that for just $3 in premium, but not quite. Look at the price of premium, how it changed on the day today. The lowest that it was, so yesterday at this time, this contract finished the day off at 217. Market opened, right? This contract dipped in value from 217 to 128. So it was down 50% at one point. Then, after Jerome Powell went in and said, like, stop being scared, don't be a little bee, buy the dip, it shot all the way up to almost $300. This right here, for real, you more than doubled whatever money you put in. So somebody might have bought $30,000 of worth of contracts at 128 because they thought, yeah, it's going to be a bullish report, and they were able to sell off probably somewhere in the neighborhood of like $65,000 to $70,000 because they were able to catch that peak. They were able to catch that dip, that peak. That's what we're doing, right? And if you held it from yesterday, well, you went through a big whipsaw only to be up a grand total of $3 or 1.38%. That's how you have to look at these plays. So volume was giant relative to the open interest. Why was it giant relative to the open interest? Because the stock, or the ticker, I should say, made some pretty big moves. So this was probably when it was around 128. This was probably around 288. And then it fell off, right? All that implied volatility, all that, and then we finished off right around 220. So that explains liquidity. Does anybody have any liquidity questions or any questions about choosing your strikes before we get into the Greeks lecture? Because I am super excited to share this with you. But if the volume is higher than the open interest, does it mean it's too late to get into that contract, for example? Absolutely not, right? Because think about it, the volume was probably higher than the open interest even down here, right? We were probably trading at maybe 30,000, maybe even 40,000 in volume at this point. And then it just keeps going, keeps going. You need to understand, though, that volume and open interest, like particularly volume, that's going to be based off of your technical levels. Volume will pick up whenever you see us break through, or it will help us break through a significant level. So when you saw us overtake, where is it? When you saw us go here, we flagged and then we overtook the high of day, right? I think it was, 23 here. Yeah, so when we hit, I think on this candle, actually it did briefly cross up above the high of day. That's telling you, yeah, we could still keep going, right? It was volume was higher than open interest even here when we started flagging, right? Boom. So it's all relative to the levels on the chart. And if the volume is still coming in, then guess what? It's gravy. But remember, right? We talked about this too. Where are we? No, up higher, up higher. Boom. Volume was only 72.93 million, and the average volume is typically 99 million. So this right here was a low volume day, right? This is a low volume day, but we still managed to move up about 56, but we still moved up. Any other questions you guys have? That was a good question. I actually like that a lot. It's never too late unless you see that the levels, like the risk reward isn't worth it, right? So like if we've broken through a resistance level and the next resistance level is say $1 away, right? No, let's say $2 away. Ask if it's just now breaking it, that's still time to enter. But the risk reward, right, is going to be different when it's moved and it's filled 50% of the next gap to the next resistance level, right? So it's up $1 of the $2. Well, now there's only $1 worth of movement left before it hits another, resistance and potentially rejects back off of it. So your risk reward was better when there was a $2 buffer between the two, right? Where you could catch it, and even if it only moved up $1.15, you still made, good money. But if it only was able to move up 30 cents, you're not going to make hardly anything. Which brings me into the next part of my lecture today. We're going to talk about the Greeks. We are finally going to talk about the Greeks, y'all. Oh my goodness. Oh my goodness. Oh my goodness. This is about to be everything. Let me hide these controls. Let me get this going. Let me get this thing going. Actually, I need to keep the controls. Display settings, and boom. All right, here we go. So when you can see my screen, drop a 1 in the chat for me. Ooh, oh yeah. So y'all see this beautiful slideshow presentation. I'm about to make it do what it does. We're about to learn about the Greeks today, and we are going to talk about how options are priced. Also, if you like this presentation, this is like the baby version of my Options Olympus course that I have. So in the event that you actually want that, even though I was going to wait until Black Friday, Cyber Monday, I'll let you guys pick that bad boy up at a very healthy discount for the right price of $25 today. If you send me a DM on Instagram and just say the words Options Olympus, I'll make you a code. All right, so let's check this out first, see if you even understand what I'm talking about. Bada boom, bada bing. Here we go. So what's on our agenda for the day today? Those of you who take notes, I don't know if you want to write this down. You don't have to. It's just giving you an idea of what's going to happen. So first, we're going to talk about what options Greeks are. Like, why do I freak out so much about them? We're going to talk about what is delta for calls and for puts. We're going to talk about how delta is measured. We're going to talk about gamma. We're going to talk about theta. And finally, we're going to talk about vega. We could talk about rho, but in reality, rho is less important than the day-to-day stuff, so I don't really concern myself with it. Rho is tied to interest rates, so when you're talking about tapering and all that good stuff, that's where Rho kind of ties in. But day-to-day, you're really only going to feel a few of them, and we're going to talk about them. So what are options Greeks, guys? What are they? Well, options Greeks are essentially the metrics by which an option derives its price, right? So they affect the options premium by time passing, as implied volatility fluctuates, as interest rates change, all those good things. Those all affect the price of an option contract, okay? And there are 5 Greeks in total, but we really only need to focus on 4, like I was saying just a minute ago. The ones that we really need to pay attention to are delta, gamma, theta, and vega, right? Delta, gamma, theta, and vega. Keep those in your mind. That's how you say them. And then the one that we pay, or at least that I pay the least attention to, is rho. All right. And the reason why I freak out so heavily about them is because a quick look at a contract's Greeks can paint the picture of your contract's type, right? Whether you have a call or a put. It can also tell you about the proximity to the money, and it'll let you know about the time till expiration. So we're going to actually take us a little quiz. I might even get a little bit fancy and pull out some like old quiz material, because it's really important for you to be able to understand how to navigate through a contract. But the main benefit to understanding these contracts is as you look at them and as you get more familiar with the Greeks, and you can just like start things off, you can look at two separate contracts, right? I have two screens when I'm trading. I can look at two different contracts, weigh the risks between them both, and then take the one that suits my strategy the best. And that is invaluable, right? Because you're not going to want to take a contract that doesn't have odds in your favor. So why are you not figuring out how to, like, what the odds are and how to, weigh them in your favor? You want to make sure you're doing that. So let's get into it. Without any further ado, let's stop talking about it. Let's be about it. Here we go. So delta. I like to call delta dollars, okay? And we're going to talk about delta from the call perspective first. So for calls, delta is going to tell you the premium's price change per $1 increase in the stock's share price, okay? So I'm going to repeat that because that might be a little confusing. And if you guys have questions, please type them in the chat for me. I will answer them in real time. But for calls, delta is telling you the premium's price change, the profit on your contract or the loss on your contract change per $1 increase in the stock's share price, okay? Delta is represented as a 4-digit decimal number between 0 and 1 for calls because it shares a positive correlation with the stock's share price. You say, oh gosh, you're using correlation. What does that mean? If the stock is going up, your call is going up because it's making you money. So if the stock is moving up, call makes money. If the stock is moving down, you're hemorrhaging money. You are losing money. So no matter what, these are going to go in the same direction. The call is moving alongside the direction of the stock. All right. Call delta is highest at the deepest strike in the money or at the bottom of the options chain, since it's calls that we're talking about. And it's lowest at the furthest strike out of the money or at the top of the options chain, since we're talking about calls. At the money, though, delta sits right in the middle of 0 and 1 at 0.5000. So remember, it's a 4-digit decimal number. Now, here's where things get really interesting. Oh, Lord, my headphones are dying out. Hold on a second. Of course, it had to happen. It had to happen. Let's just...
Back into it like we never left. I'm so sorry. Hide floating controls, display settings, flip it. All right, my apologies, that won't happen again. So, some traders are going to use delta as a probability. Now, this is where things get really interesting. So, when I say that they're using it as a probability, they're using this as a 4-digit decimal number to determine whether or not this particular option contract will make it in the money at expiration or not. That has become the single most powerful thing for me as a trader, because now I don't have to just feel like I'm biased. I can look at the Greeks and I can determine, oh, if I'm going to sell to open, this has a 25% or a 30% or an 18% probability of making it into the money. Now I can feel less worried because I have a statistical advantage over everybody else, right? Or over, how should I say, a statistical advantage in my strategy. I have an edge. You might hear people say edge, edge, edge. That's what they're referring to. So just, keep that in the back of your mind. Delta is a probability. They use it as a measure of a contract's probability of making it into the money. And we talked about that whole intrinsic and extrinsic thing, right? So as an option buyer, you can now say, oh, I'm picking up a contract with a 40% probability of making it into the money. Like it might not happen, but I have some news. I have a catalyst that I think that's going to push me into the money. So I'm going to take this. It's a riskier contract, but I can pay less and make a great return on my money, a better return on my money. So you'll typically want your shorter options plays to be contracts that are at the money in either direction. And that's because, remember, we talked about at the money delta sits around 50. So if you're buying an option contract with a delta that's around 50, a $1 increase in the stock share price means that you make $50. It's not too shabby. So we talked about delta for calls, right? Let's keep it going. Delta dollars for puts. Now, this is where things are going to get a little bit confusing. Well, no, I shouldn't say they're going to get confusing. This is where we start talking about things from the opposite perspective. Let's put it that way. More positivity, higher vibration, saying it that way. So for puts, Delta tells you the price change per $1 decrease in the stock share price. And put delta is between 0 and -1, okay? So for puts, it's always represented as a negative number because it shares a negative correlation with the stock share price, okay? Stock goes down in price, put goes up in money. Stock goes up in price, put loses money. Boom, right? Makes sense. Pretty simple. For puts, though, delta is highest at the deepest strike in the money, which is at the top of the options chain. So puts and calls, their options chains are flipped. Calls in the money is at the bottom, puts in the money is at the top. And the furthest strike out of the money for puts is at the bottom of the options chain, and it has a delta that is sitting closer to 0. At the money, put delta sits at -0.5000. All right. So for puts, delta will always be a negative number. That is the fastest way to recognize the type of contract you have. So for example, at one point when I didn't have such a huge following, I would have people send me their contracts. I'd be like, just DM it to me on Instagram. And I would look at their position and they wouldn't tell me anything. And I'd be like, well, I'm trying to figure out what's going on here. So I would have to decipher for myself. I could tell whether they were in a call or a put based off of what the delta was. So last little bit, fun fact that literally no one on planet Earth would find fun except me. We can use at the money puts during our quick scalps for larger gains than our out of the money plays, all right? This is because, well, we're gonna talk about it a little bit in the future, but because of the way that our Greeks are structured, when we're at the money, we are able to make more money based off of volatility. So let's actually look at what delta, just like a visual aid, because I put lots and lots and lots of visuals and quizzes and stuff into this these presentations because I need it to be driven home for everybody. So this is call delta in blue, and this is put delta in red. So you can see for calls 0 to 1, right? It's represented 0 to 1. For puts, it's represented 0 to -1. And it's literally a reflection over that x-axis, right? It's literally the same picture, just reflected. So as you can see, out of the money, we're close to 0 for both calls and puts, right? When we're at the money, if we were to draw a line, it would fit right in between 0.4 and 0.6 because it's 0.5, right, at the money. And then deepest in the money, we can see that it is closer to 1, right? It's asymptotic. So now let's talk about asymptotic things for a moment here because this is going to be very important in the future. What does asymptotic mean? Do any of you guys have any idea what asymptotic means? Before I just sit here, I'm over here pretending like you have no idea. Y'all might be like mathematicians. Asymptotic. Have you ever heard that term? I'll type it in the chat. Everyone. Asymptotes. Yes. Yes, my math brain's in here. Yes, Jordan. Yes, yes, yes. Okay, so it's the same concept like in math. So what you'll notice, I didn't really do a good job putting the example here. It actually should be 0.0001, and this should be 0.9999. So this is correct, but this one isn't. Asymptotic means that it gets very close, but doesn't actually touch it. So what you'll notice is it gets really, both of these actually in this visual aid get very, very close to 0, but they don't actually touch 0. The reason why is it wouldn't make any sense for us to have an option contract with a delta of 0, meaning you make no money based off of the stock moving up $1. You have a 0 delta if you don't own shares of stock at all. I've had a 0 delta in Amazon my whole life up until 2020, right? Because then I started actually buying Amazon. If you have no delta, you're not in a trade. On the flip side, for in the money, right, we can get as close to $1 as possible, but we're trading an option contract and we're not actually buying shares. So what do I mean by that? If we had a 1 delta, that is the same thing as owning 100 shares of stock. Why? Well, if each share, right, goes up $1, right, our delta is 1, then that means 100 shares go up $1, meaning we make $100. That's the same thing as having a 1 delta. In this example, if the stock goes up $1, our delta is 0.999, so we make almost $100. We're pretty deep in the money. We're so deep in the money that we're acting as if we own 100 shares almost, right? $99.99 is pretty darn close to a full-blown $100, right? So if you have 100 shares of stock and the stock goes up $1, you have a 1 delta, so you make $100. For option contracts, the lowest that we can make is a single cent. the highest that we can make is $99.99, because it wouldn't make any sense to have a 0 delta. That's like if you don't own anything, and it would make sense for it to be a 1 delta, because that would mean you already own 100 shares of the stock. If you're following me, drop a 1 for me in the chat. If you're not understanding what I'm talking about, drop a 2 in the chat for me. Okay, see a 1 popping up. Talk to me, talk to me. What do y'all think? Stuff still confusing? Because I'm really trying to make sure y'all get this. Okay, Stacy, what's going on? What can I do? How can I explain it to you a little better? Talk to me. Talk to me, talk to me. Is it something that I said about delta in particular? This chart right here. Okay, what about this chart is confusing to you? Like, is it about the fact that both the call and the put are on the same thing? So it's all representing the same, right? Out of the money, at the money, in the money. For calls, out of the money is close to 0. And as you can see, this blue line, it's close to 0. Doesn't actually touch it, but it's darn close because of the asymptotes, right? Asymptotic. At the money, we're midway to 1. And for puts, we're midway to -1. And we can see that if we were to draw a line, it would be right here at 0.5. At the money delta for calls is positive 0.5. At the money delta for puts is -0.5. And then if we go all the way to the end where this in the money is, we get darn close to 1, but we don't actually touch it. And for puts, we get darn close to -1, but we actually don't touch it. So this is just a visual example of what delta looks like for each position along the options chain. In the money, at the money, and out of the money, all 3. That's essentially what I'm trying to say, if that makes sense. You following me? Or is there something? You can unmute yourself if you need to. I'm totally down to talk to you if that'd be faster than you typing. But I want you to get this before we move on to gamma, because if you don't understand delta, gamma is definitely not going to make sense. When looking at a stock, does delta fall in between the number? In between the number, what do you mean? Does delta fall in between the number? So mind you, delta is telling you this is regarding your profit. So this isn't the same as your strike, and it's not the same as your, I guess I don't understand your question. Delta fall in between the number. What number? In a stock, does delta fall in between the number? Are you talking about the share price? This does not have anything to do with the share price. This is saying that based off of the change in the share price, this is how much money your contract's premium. Remember, we talked about premium is what you pay to enter into a contract. This is saying how your premium changes, or how much the value of the contract will change. So if you have an at the money contract and the stock goes up $1 and it's a call, you're going to make $50. If you have an out of the money contract and it's a call and the stock goes up $1, you're going to make closer to $0 than anything. If you have a deep in the money contract and it's a call and the stock goes up $1, you're going to make close to $100. On the flip side, if you have a put, stock drops and you're at the money, you're going to make about $50. If the stock goes up though, and you have a put, you're going to lose $50. So this is what it's saying. This is telling you how much premium you're going to gain or lose depending on where you decide to purchase your option contracts. Delta is telling you how much of that premium you are going to gain or lose depending on if you are correct about the directional assumption of the stock. So if you are correct, you have a call and the stock goes up, or you have a put and the stock goes down, then you are going to add that delta number to whatever your premium is, and that's going to be the new amount of profit or loss that you are incurring on that position. Okay, cool. Okay, I see some ones. Okay. Listen, sometimes I'm talking about this from the perspective of someone who uses this to make a living. So someone who's never heard of it before is like, what the hell is she talking about? Oh, Cheryl, talk to me. What's going on? How can I help you out? Before we move on to gamma, because I'm telling you, it's important to get this stuff down. What's up? How can I help? You can unmute yourself too, guys. If you have something that you want to ask and typing is too tedious, I have no problem with that. Any question, any question, any question? I thought the increase or decrease was adding to the premium's price. Yes, that's exactly what's happening. That's exactly what's happening. You are correct. It is adding to the premium's price, your profit and loss. Because remember, as the premium changes, your profit and loss is also going to change. I'm using those two things, those two terms interchangeably. The premium's price will change, which will then also affect your profit or loss. But you said it cuts into profit, or maybe I'm understanding it wrong. No, well, it can. It'll cut into your profit if you're wrong, right? You see what I'm saying? Like if you're up $100 with a call and the stock drops $1 and you're playing at the money where your delta is 50, your profit is going to go from $100 to $50 because you were incorrect. The stock moved again. Oh, okay, you get it? Yeah. The stock moved against you. You're going to lose money. That's going to affect your profit and loss. It's going to affect the price of premium for that contract. So as the premium on the contract changes, your profit and loss is going to change because you locked it in at one price, and it's either going to go up from there or it's going to go down from there. But one way or the other, delta is going to change that based on if the stock is moving in your favor versus against you. That's what's going on. You guys got me? Okay. All right. Let's continue. So here's a visual because I figured that it would be a little bit confusing, and I'm going to just kind of like talk us through it using Tesla as the example. Look at it, 642. Freaking crazy, man. Freaking crazy. So we're looking, and along the options chain, we click September the 17th, quad witching, and we switched over to calls. You can see that right there. I clicked that button. So here we go. We're looking at this 660 call. Our delta is 49.48, right? That's because it's sitting right there at the money. So we scroll way far out of the money to the $1,000 contract, super far out of the money, right? Click that. Our delta right down there is $3.55 because we take that decimal and we move it to the right, $3.55 based off of a $1 increase in the stock share price, next to nothing. Now I'm scrolling deep in the money. I think I click on 250. Oh no, I click on the 200. Boom. Look at the delta here. $99.61 based off of a $1 increase in the stock's share price. This contract is $44,500, y'all. Look at that. Isn't that crazy? Let's go back for a second. So I'm scrolling through, right? I'm finding myself a little contract in the future. We'll talk about how time affects the option contracts, but let's look at this one more time. Boom. 660 is right here at the money, right? These contracts are $4,635, right? That's pretty expensive. Our delta is almost 50, right? Let's go back for a second. 49.48 was our delta. Let's pause it. Boom, right? Delta 49.48. We take that decimal, boom, boom. $49.48 was our delta. So it's close to 50. It's at the money. The delta is 50, give or take. It's not always going to be 50 on the nose. Obviously, things are dynamic. We scroll way far out of the money though, right? Check this out. So this contract, it's for a $1,000 call. So to buy Tesla shares at $1,000 a pop, the contract only costs you $185, but the delta is only $3.55. So it's like you're barely making any money, you know? It's really a speculative thing. And then, oops, I reset it. So the contract is only $100. This contract here, $44,375, right? $44,565. So this is a very deep in the money contract, and our delta is $99.61. So if Tesla goes up a single dollar, this contract is going to gain $100 in value almost instantly. That's what I want you to be able to see about delta. Why would you check delta deep out of the money and deep into the money again? Because it's still going to let you know. You still want to know how much money you're going to make based off of a $1 change in the stock share price. And if you're playing out of the money super far, think about it. Remember I said that delta is a percentage probability of you coming away with your contract being in the money. This has a 3.55% chance of making it in the money. Would we want to trade something like that? Probably not, because remember I told you how out of the money options will expire worthless, right? So we probably don't want to go and get in on something that's so cheap. I mean, we can absolutely buy it and the stock could go up and we could make money, but it's not going to be the significant gains that you really want to see, where it's not 2020 anymore. Um, is that volume saying that one person has purchased that contract? Yeah, on the $44,000 one, this right here, yes. So on that day, one person spent 44,000, at least anywhere from, where was the low, $44,447 to upward of $44,565. One person spent that much money. Isn't that insane? It's crazy. I play out of the money because of limited funds, so I count on volatility slash momentum to get gains and get out. That's fine. You can absolutely do that. Yeah, absolutely. But I think that after this, after you learn about all of this stuff in this slideshow, you may consider playing a little bit closer to the money on high conviction trades, because you'll be able to scale up your account faster. I bet you if you've been in the game for a little while and your account is still small, it's just because your risk reward is off. So when you do get clapped on those positions, you're taking a much heavier loss than the actual gains that you're getting. So full disclosure, just keep that in mind. But yes, you can absolutely play out of the money. I played strictly out of the money up until probably the final, like, Q4 of 2020. So now, here we go. Let's do a little quiz question. This one's interactive throughout the entire slideshow, because I felt like it would be good to keep you on your toes. So you're looking at two contracts, and they're both strikes at the $45 right mark for a stock that's trading at $43.55. One is a call and the other is a put. Which one is which? So the contract on the, so you can either say left or right, and then how can you tell? Let me know. That's the question. Which one is the call? Which one is the put? And how can you tell? Okay, okay. Every single person so far has got it right. Yep, yep. Boom. Absolutely correct. 100%. If you answered like this, you're already getting it. You're already starting to act like a pro. Yes, negative delta puts. Absolutely. Bada boom, bada bing. Look at that. So now let's talk about Delta Dollars' best friend. So Delta does not ever come alone. Delta has a BFF, a for lifer, and that for lifer's name is Gamma. Gamma, Gamma, Gamma. I call it Gamma Gains. Gamma should be every option buyer's best friend as well. Let me explain. So for both calls and puts, Gamma tells us the change in Delta from a $1 move in the price of the stock. Okay? So notice that I said the change in Delta, not the change in anything else. It's telling you the change in your Delta. So, because remember, right? You're like, well, why does, out of the money options, why is their Delta so small? But then at the money has a Delta of 50, like, right, of $50. That one contract we looked at had a Delta of $3.55, but the at the money had a Delta of like $49.80. Why? That's because of Gamma. Okay, so it's always represented as a positive number, but it behaves inversely with Delta for calls and puts. So we're going to talk about that right here below. If it doesn't make sense, don't worry, I'll still explain it again. So for calls, if the stock decreases, you're going to subtract your Gamma from your Delta on the second dollar decrease. For puts, if the stock decreases, you add your Gamma to your Delta on that second dollar, and every dollar following it decrease, yes. For calls though, if your stock is increasing, you're going to add your Gamma to your Delta on the second dollar increase. And for puts, if the stock increases, you're going to subtract your Gamma from your Delta on that second dollar decrease. So that was a whole lot, and I'm sure that none of it stuck because it's a little bit confusing, but I'll put it to you like this in one simple sentence. If you are correct about the directional assumption of the stock, right? You buy a call and the stock goes up, or you buy a put and the stock goes down, then you get to add your Gamma to your Delta, because your Delta is going to get larger. You were going to get rewarded for being correct. If you're incorrect, you buy a call and the stock drops, or you buy a put and the stock shoots up, right? Then you are going to be hit. You're going to be impacted negatively. So your Delta is going to shrink. You're getting pushed further out of the money. When the stock is pushing you deeper into the money, your Delta is going to get larger. When it's pushing you further out of the money, your Delta is going to shrink. Does that make sense? Drop a 1 if you get it, drop a 2 if I didn't make any sense at all and you're like totally lost. I know it's a lot. Ones if you got it, twos if you don't understand what I'm talking about. Okay, I see some ones coming in. Oh my, oh my, oh my. Y'all are gonna be vicious in the markets. I hope y'all join Profit Rocket Club. We could use some fresh faces like y'all. I'm gonna be in here talking about Greeks with y'all every day. We're gonna be getting this money. Ooh, I love to see it. So I got you. I got you. Listen, Kay, I got you 1,000,000%. We got examples on Delta, we got examples on Gamma, Theta, Vega, the whole nine. I'm gonna hook you up. But first, I want to give you the secret sauce and make sure that you know everything that there is to know about Gamma. So, number one, we only count Gamma on the second dollar move because Gamma from the previous dollar's movement is what created the current delta that we see. So therefore, there's no need to count it twice on that first dollar move, right? Like to get the delta that we currently see, we already had to factor in Gamma. So that next dollar, that it moves up. Now we can effectively put in our Gamma, either add it or subtract it. And now bada boom, bada bing, we have the accurate delta. Okay. Now, this next little bullet right here, it may only be like 7 words, but this is so, 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 so important for you to understand. Gamma is highest in at the money options contracts. If your contract is at the money, Gamma is at its peak. Okay? So, what does that mean? Let's think about this for 2 seconds before we move on to these last couple dots, right? So if Gamma is highest in at the money options contracts, and at the money options contracts have a delta of 50, that means that if you're correct and you're playing something at the money, then you're going to receive a bigger change in delta than you would if you had bought something that was further out of the money or you bought something that was deep in the money. Because remember how I talked about asymptotes? Well, if Gamma is changing your delta, at some point Gamma is kind of negligible. It's negligible, right? At 0, there's next to no Gamma there. And when you're deep, deep, deep in the money, close to 1, well, you've already gained pretty much all that Gamma can give you, So at the money, you're going to see the most dramatic gains, the most dramatic changes to your delta. And that's how the big money starts coming in. One thing, I was talking to a friend of mine who's a much more experienced trader than I am. And he has a friend who traded on the Chicago Board of Exchange floor or something like that. But he was saying that his buddy was like, as for all the years that I worked, with this hedge fund, and for all the years that I worked trading options and leveraged securities, every single time that I was trading them, I was buying stuff that was in the money. But now he's like, yeah, I've looked at the money, I've looked at, et cetera, et cetera. He doesn't really trade super far out of the money at all, but he's like at the money and, a couple strikes in the money, I'm willing to look there. Rather than looking so deep in the money because they have, billions of dollars of capital to deploy whenever you're working for a fund. So just something to keep in mind. Gamma is biggest at the money, and it can definitely be useful for you. If you are correct in your directional assumption, the gains will come to you faster. Let's see. What's the secret sauce in building small accounts using the Greeks and not playing way out the money? Spreads. I've literally paid $200 for a spread and come away with $1,200 off of it a few days later. And I also wasn't paying, no theta decay hit me. I was good to go. Spreads, absolutely. So is this why people roll up? So yeah, so it depends, right? If I guess rolling up, give me an example of what you mean by why people roll up. Like rolling options though is just to get just to like move your risk reward back into the range that you like, or to get your Greeks back where you want them, or for whatever reason. People have a million different reasons to roll, but rolling is essentially just like closing out a position in one space and then buying another one. After they're in the money, yes, that is why that they would roll that position. So they would go in, they would get into a position, it would move into the money. They've now made a significant gain. They would close out that position, right? Collect those gains and then roll it, meaning they would go into a further expiration date and buy an option contract that's at the money now, that's the same value of the contract before that they had purchased, if they believe that the stock will continue with its uptrend, because they were already deep in the money. They were just like, yo, sometimes you can get too deep in the money and it can be hard for you to sell. Like that $44,000 contract that we saw. I hope that happens for you, where you have so much money that you're like, oh, I need to get rid of it. Like, I need to sell this before it becomes too illiquid. That's a great problem to have. But nonetheless, yes, that is essentially why people would roll it. All right, great. So gamma is represented with a positive number on both the call side and the put side, because it's equal to the same amount no matter what you're doing. Like, if the stock goes up, you're just going to add if you have calls. If the stock goes down, you're just going to subtract if you have calls. Vice versa for puts. If the stock goes up, you're going to subtract for puts. And if the stock goes down, you're going to add for puts. That's the whole reason why. So the movement of the stock price will dictate which direction and how it affects your delta, but it's all the same thing. So I know that this is really strange, but think of gamma as acceleration. You know what I'm saying? So like, you have your speed, but then you have your acceleration, like the rate at which your speed is changing is your acceleration. So it's the first derivative of delta. If that doesn't make any sense, that's totally fine. But just make sure that you can keep that in mind, that it's the rate of change of your delta. It is how much your delta is changing based off of a $1 change in the stock share price. So delta is telling you the change relative to the share price, and gamma is telling you the change relative to basically the stock share price change in delta, right? So gamma changes delta, delta is changing relative to the stock share price. Does that make sense so far, before we get into the examples for gamma gains, delta dollars? Got me? You got me? I hope you do. I hope you feel me. All right. If not, ask your questions. Like I said, I'm happy to answer. All right, let's keep it going. We're getting good. We're getting, going at a good click. So let's do an example real quick. So we're going to find our new delta using gamma. All right. So example, the stock price for Wealth Hunter Incorporated increases from $50 to $52. You want to choose the best call for the following day when they release their newest product called The Art of Earnings. You look below and you see two different contracts to buy. Which one has the best return? All right, so let's talk this through, and let's actually think about this, because this is how I'm going about calculating profit, loss, all this good stuff for my contracts. First and foremost, all of these 4-digit decimal numbers, when you see on the Greeks, you need to take that decimal and move it to the right twice, period, or multiply it by 100. You'll hear people say multiply it by 100. That's just nerd talk for saying go like this. Whoop, 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 whoop. All right, easy money. So the first thing that we're going to do is we are going to move our decimals over, just like I said, right? Boom, we get $48.16 for example 1 for our delta, $8.32 for example 1's gamma. Example 2 has a delta of $35.12. Example 2 has a gamma of $1.32. Step 2, we now know that on the first dollar increase, we don't factor in our gamma, but on the second dollar increase, we do. So we get this formula as a result: delta 1 plus our delta 1 again, plus the gamma, which creates delta 2. So this parentheses here, delta plus gamma, that's going to be our new delta, or delta 2. This here is just our original delta, or delta 1. So let's do the math. So we plug in our information. Delta plus gamma is 4816 plus 4816, right? That's our delta again, plus our gamma of 832. And then we add that together, 48 plus 56, 104, right? Same thing here, 3512 is our delta. 3512 is our delta again, plus our gamma of $1.32. So 3512 plus $1.32 gives us 3644, right? This added together. And we add our delta, and that gives us 7156. So looking at these contracts, we can see that 104.64 beats out 71.56. So the contract on the left will be the best one to buy in this instance. If you understood what I just said, You just calculated gamma easily. Congratulations, guys. That's fantastic. That is absolutely fantastic. So, is there anybody in the chat right now who was like, yo, none of that, what you just said, made any sense whatsoever? Is there anybody that doesn't understand what I'm saying? I want to make sure. Drop a 2 in the chat if you get me. Drop a 3 in the chat if you don't understand and you need me to break something down. Okay, I see some 2s, I see some 2s, I see some 2s. Oh, we're about to get us some money. Okay, cool. Let's move forward. Good job, guys. Now here we go. It's about to get a little more complicated. So get your pen and paper out because this time I'm not going to answer the questions. I'm going to allow you guys to work through these. All right. Quick quiz. Let's get it. Which contract is most likely at the money and how can you tell? I'll let y'all answer in the chat too if you want to. If you don't want to write it down on a piece of paper, that'd take you too long. 2 for the gamma. Example 2, example 2. Okay. Example 2, example 2. Example 2 is correct. Good job, guys. So funny enough, actually, I was looking at the delta. So yes, even though you said gamma is the reason why you chose it, that's actually correct. Most people don't typically think about gamma. So I'm actually very impressed with those of you who said gamma, but the delta. Remember I said at the money delta is close to 50.5. So we're at 52 for this one, and this one's at 27. But also, yes, you absolutely could look at gamma. I'm so proud, guys. This is amazing. Your gamma here was $6.42. Your gamma here was $13.72. Guys, yes. Yes. Okay, so which contract would lose more money from gamma? Example 1 or example 2? It's 2s. I see some 2s. Okay, I see some 2s. So I see somebody said 1. Okay. Which one would lose more money from gamma? 2s. Okay. So the answer to this one is example 2. Because remember, if we multiply our gamma by 100, we move that decimal over to the right twice, just nerd talk, we come up with 1372 for example 2. And that is larger than $6.42 that we would have for example 1. Does that make sense? Bada boom. And finally, ooh, this one is good. What would the new deltas be for both examples after the second dollar decrease in share price? So think about this. This is different than the question that I asked you earlier. What do we know about what gamma does to delta on that second dollar and every dollar moving forward? We know that it's going to affect it. But we know, what do we see at this problem here? Well, we see positive deltas. So if the stock goes down on a positive delta, then that means that we're going to do what? We're probably going to be subtracting that gamma from that delta, right? So, yes. Subtract it. So, give me your answers. And let's see, I'll do the math here too, even though I've done it before. And if you want to be able to access basically the same version of this quiz, but a little different, like I said, just hit me up on Instagram. I have the quiz to work through and some other content. All right, give you a minute. Boom. Okay, I got example 1. And then I need to do example 2. So we got what? Our delta is 52.16, right? Our gamma is 13.72. Oh my. Here we go. Sorry, there's some people coming in and out of here. All right, you got your numbers? All right, so for my first one, for my example 1, I got a grand total of $21.03. You see that? 21.03. And for the second one, I got 38.44. Can you see that? Boom. Oh, y'all are too good with it. I see the answers being dropped in here left and right. Yes, indeed. Absolutely. Both are correct. Both 38.44 or 0.3844. I will accept. That is accurate. Phenomenal job, guys. Phenomenal. So now here we go. Kay, this is where your examples are going to start coming in. I hope you're still here. So check this out. So this right here, this red line represents delta for calls, and this beautiful blue line that you see here represents call gamma. So what can we tell about this stock just by looking at this one picture? Well, remember we said gamma is highest at the money, so we can determine from this picture that this stock is most likely $25. And obviously if you ignored the hint that it says $25 call and put, but like if you see here, right, gamma is really low when we're close to zero, and then as we approach 25, it hits its peak, which is at the money, and then we get deeper and deeper into the money, it tapers off. But as you can see, when we're far out of the money for our delta is next to nothing. We get up here, we get up here, we get up here. Midway through, it's at 0.5, right? And also at the same time that's where the peak is, right? So not only is our gamma at its peak, but also our delta is at 0.5. No coincidence. As we keep getting deeper and deeper into the money, our delta approaches 1. So that's a call. That's literally what we're looking at, delta and gamma. Does that make sense to you guys before we move into theta? Like, are you understanding what I'm talking about here? Drop a 1 in the chat for me if you get me. Drop a 2 in the chat for me if you don't. Yes, yes, yes. Phenomenal, phenomenal, phenomenal. Oh, this will make you the big bucks. Kay, I love it. I love it. I love to see it. All right, so here we go. Let's move forward some. Let's talk about theta. So this right here, this slide, I know that I usually don't tell you to write down everything you see, but out of all the things that there are to see in this entire slideshow, this is probably the most important slide to you guys, because a lot of new traders get clapped because they don't understand how to manage theta. So let's talk about it. So we had delta dollars, right? Gamma gains. Those two are price contingent Greeks, meaning they only change if the stock's price is changing, right? Sorry, there's so much noise. I hope you guys can still hear me. They're doing the most out there. So it's only going to change based off of the price changing, delta gamma. Theta is time contingent. It will change based off of time changing, okay? So theta is the option contract's way of telling us how much money we're losing due to time passing, okay? That's why it's time contingent. And theta is always eating away at our contract's value, whether it's a good play or not. And it's represented as a negative number for option buyers, okay? So for you and anybody else that's in here, and even me sometimes, this is going to be represented as a negative number because it is taking away money from us. Now, I already know what questions people are about to ask, so I put them in the slideshow. Number 1, theta does not hit us all at once. It is continually happening during the market hours. Weekends and nights are priced in. So if you have a position on Friday and you're like, dang, I want to swing it to Monday, but theta is going to eat me up. Doesn't work that way. Theta is priced in for the weekends and for any time that the market is closed. What you see for theta is only during active market trading hours, not for after hours, nothing. Is it going to make a dramatic change at market open? Yes, but that's only because of implied volatility, and we'll get there when we talk about Vega. What you need to know is that theta is only active while the market is open. Everything is priced in, okay? Next, the only way to shrink your theta is to either have a time machine, which if you do, I would love to hear about it. I would love to see it. I could make us both quite wealthy. If you have, you want to give me access, I'd love that. If not, though, we have to buy a call with a further out expiration, okay? So we have to buy time. People say, oh, I'm putting time on it. I'm buying time. This is what they mean. They're putting more time on the option contract, okay? So I'm going to actually show you how theta increases for all 3 positions around the money, because I think that's also vitally important for you to see. But what you need to know is that theta increases during the final month to expiration and increases intensely during the final week to expiration. So for example, when I'm doing my credit spreads, I like to do them about 30 to 45 days out because that's when theta starts to pick up. But on Fridays of every single week, I like to be able to milk a few $100s up to a couple $1,000s off of Amazon because their contracts are super expensive, but theta decay is ridiculous, like going dumb crazy. Like I've seen theta be $1,000 on those contracts. So I know that all I have to do is wait, and as long as the stock doesn't move above whatever the price that I sold to open, I'll be able to collect 100% of that premium. Easy money. It's the same idea as a seller for me though. As a buyer, you have a little bit of time left on the contract. It's being eaten away very quickly because it's close to expiration. So yeah, like if I'm putting on a credit spread, 25 days till expiration, I can collect that premium as a seller. But as a buyer, right, once you're buying something that's a weekly, after Wednesday, that time decay is kind of crazy. It can get kind of bananas. But many new traders will pick losing trades because they don't know how to properly manage their theta. And that's unfortunate because if you knew how to manage it, you would never get clapped like you do. But let's actually go over the visual. This has been like the single craziest, most helpful resource that I use in this PowerPoint. For multiple people, I've had people say like, yo, Hunter, like I literally hit on my next play because I managed my theta. So let's look at this. So there's 3 different lines here represented on this chart. We have premium price as the y-axis, which is this vertical line here. And we have time as the x-axis. We go from about 120 days out to all the way down to expiration. And plotted along this XY axis, we have in the money in red, at the money in green, and out of the money in blue, right? So what do we see? Well, first and foremost, we can see that right around that 90 days, that out of the money contracts start to really lose that value. And as we approach closer to that 60-day mark, things are really ramping up, right? And then it kind of just gradually smooths out and loses value. On the opposite end of the spectrum, right? So in the money contracts, they kind of have a gradual loss, and then we hit right around that little, 30 to 40 days to expiration, and then things dump off dramatically. And what we're left with is either you're going to be pushed in the money or you're just not, right? So we see that with those at the money positions, like, we're moving, and then we kind of just dump off right towards the end. But for our in the money options that we see on the opposite end of the spectrum, it's just kind of a gradual decline all the way through, just pretty even keel. And that's because in the money options are moving quite similar to actual shares of stock the deeper that you are in the money. So this is just the natural depreciation of that extrinsic value, right? All of this has to do with extrinsic value. So we can see our out of the money contracts lose value so quickly because all that there is extrinsic value. Whereas with our at the money positions, it loses pretty quickly, pretty dramatically right there at the tail end because it might be hopping into the money and then might, get pushed out of the money, then hop back in and then pushed out and then, then it decides it's back in. So it all depends. So let's do a visual of theta because I think that's important. I think that we need to be able to understand how it really affects us with a real world example. Good Lord, somebody's dog. So we're looking at 3 different expiration dates here: September, October, and December. So for September, you can see, right? If we decided that we wanted to pick up, let's just say that this was, September the 5th, right? If we wanted to pick up a September the 10th expiration contract, we would be experiencing a grand total of $8 of theta decay every single day, right? If we decided that we wanted to pick up an October 10th, so we just kicked it out one more month, we reduce our theta exposure by 50%. Look at that. We go from losing $8 a day to losing $4 a day, maybe $4.25, right? It's crazy. If we pivot out one more month to December, we cut our exposure by about maybe 30 or 40%. And now we're looking at like $2.75 instead of $4. So what you need to understand is the more time that you put on your contract, right, from September to October to December, actually that's 2 months that we kicked out, right? There's no November. So pivot out 2 months, boom, you reduce it even more. We need to understand that the more time we add to our contracts, the smaller that our theta decay is going to be. Less theta decay, less money we lose on the day. But something that you need to understand about theta as well is that what you see for theta on that particular day is the absolute lowest that theta is going to be for that contract. That is the lowest. The next day, theta will be a little bit more. So maybe one day you see it's $5. The next day, it might be 6. The next day after that, it might be 8. The day after that, it might be 12. The day after that, it might be 26. It's going to compound. Theta will continue to increase and increase and increase. So before we move on to Vega, let's talk about it for 1 second. Does anybody have any theta questions? Anything that doesn't make any sense? Is there an advantage / disadvantage to buying shorter time frame contracts, 1 week or weeklies? Yes, absolutely. There's give and take for everything. Understand, the more risk that you incur, the greater the reward is that you will be able to reap if you are correct, but it has a lower probability. The market needs its pound of flesh. Weekly contracts experience implied volatility, like the effects of implied volatility, much stronger than further out expiration contracts, which we're actually going to talk about literally on the next slide. But weeklies are a great way if you, are just trying to, how do I say? Weeklies are great if you are trying to bet on the short-term movements, but I'm not the biggest fan of swinging weeklies unless you have something to offset the theta decay. So like, for example, I trade weeklies all the time, but I never buy them. I only sell to open weeklies. And then I buy the week after that because that reduces the theta exposure on that contract that I've bought. And therefore I'm actually in a long call like normal, but it's actually I'm getting paid theta. So I'm getting paid to sit there and wait. So bada boom. Can you see the definition slide again? Theta definition like this. It doesn't really define it on here, but it's just, you can write that theta is the natural depreciation of an option contract. That's plenty. All this is kind of just a little extra. So yeah. Now, wait, before I go forward does anybody have any questions about theta decay? I want to make sure that we all understand how theta works and that we get it, because if you don't understand theta or you have theta questions, I'm here to answer them. I'd love to make sure that you're good to go before we get into Vega, because this is when things are really going to come together. So can you explain the difference between buying a call and selling a call to open? Sorry to go off topic. No, it's all good. So buying a call, all of your Greeks look like normal, right? All your Greeks are the same. You buy a call because you anticipate appreciation in the stock share price, right? Well, you sell to open a call because you expect that the price of the stock is going to actually decrease. So you sell to open when you expect a decrease. Selling calls is bearish. Selling puts is bullish. Buying calls is bullish. Buying puts is bearish. So it just flips the purpose. And as long as your call that you sold to open is out of the money at expiration, you will collect 100% of the credit that you received for selling that contract. Someone pays you to buy that contract off you, you keep 100% of it if you are out of the money at expiration. So if you find a lot of your trades are ending off out of the money, maybe you need to consider selling to open the positions rather than just buying them. But it's a little bit more advanced. But yeah, that's the difference. So next, Vega. Also dramatically overlooked. So Vega is a measure of how much options premium you will gain or lose due to a 1% change in implied volatility. Okay. So if your implied volatility increases by 1%, you're going to add your Vega to your premiums profits. And if it decreases by 1%, you're going to subtract your Vega from your premiums profits. And so once again, right, this ties into playing earnings. So we can always talk about this in a future week, or if you guys are interested after I get done with, talking about all this, I would love to go over it with you. But Vega is super important if you ever want to trade earnings. Please do not listen to these idiots that are telling you that you can, oh no, just go ahead and buy something long and swing it through earnings. No. And if I showed you a chart of what it looks like after earnings are reported and how Vega or implied volatility collapses, you would be like, why did I ever listen to this person? This is why I say it's important for you to listen to the right people and to make sure that you read, because if you don't, people will just Put it right under your nose. They'll let it pass right by you and you'll never know. I'm just trying to get a check off you. All right, so let's see. So, like Gamma, Vega is also largest at the money. So, remember how I was telling you earlier that we had Vega profits and Vega was like essentially we talk about Gamma, right? So, Gamma was greatest at the money, and we were using the fact that Gamma was highest at the money to, oh, hold on one second. uh, we were using Vega to be able to, or Gamma, excuse me. Let me backtrack so you're not confused. So Gamma and Vega are both greatest at the money. So when we're trading options, when we're looking to get into any kind of option position, the reason why we want to play at the money rather than play farther out of the money is because the rate of change of our delta, the amount of money that we'll make based off of a $1 move in the stock share price, is going to be more dramatic, it's going to be more pronounced. So for example, let's say that you are in a stock and it's $100, right? And the stock goes from $100 to $102. If you play something that's at the money, or excuse me, if you play something that's out of the money, you might get a delta of like 20, right? So you come away with $40. Your Vega goes up a little bit. Maybe you come away with, $45. If you play something that's at the money, right, where your delta is $50, you're going to be able to make $100 just based off of your delta originally. On top of that, then you're going to make money from your Vega as well, because your Vega is largest at the money. So you might be able to come away with 120, 130, whatever. Your Vega is going to be more pronounced in at the money positions. That's the main thing I need you to be able to understand. If you can understand that, you're going to be in great shape. You're going to make a lot of money trading options. This is what I do. Vega volatility. You can use it to hedge, but we'll get there once you get a little bit more advanced. So Vega is fundamentally important if you wish to execute a strategy around playing earnings, right? So when people say that they got IV crushed or they lost money despite a stock moving in the direction that they wanted it to, it's because of Vega. It's because the volatility crushed them. They lost all of that extrinsic value. Remember how I said that there was intrinsic and extrinsic, and extrinsic is tied to time and implied volatility. Time is theta, implied volatility is Vega, time and volatility. So it's the same idea here. If you understand what I'm saying so far, can you drop a 1 in the chat for me real quick? And if you don't understand what I'm saying, can you drop a 2 in the chat for me real quick? Yeah, you got me? You feel me? You feel me? All right, all right, all right. Let's see. So, final thing that I want you to be able to understand is that contracts with more time till expiration naturally have a higher implied volatility and Vega exposure. So, the more time that you have, the more opportunities for the share price to fluctuate you have. So, that's why whenever you asked me, like, hey, is there an advantage to buying a weekly versus something that's a couple weeks out or a month out or a few months out or whatever? Yes. The sooner that you are, right? The closer that you are to expiration, the more pronounced implied volatility is going to impact your options trade, because that's a low probability thing, right? What are the odds that implied volatility shoots up 5% in one day versus implied volatility going up 5% over the next month? It's way less probable that you'll see that happen, especially on the final day to expiration. But if it does happen, you're going to make a lot of great money. And that's Vega gains. That's extrinsic value gains. So that's how I want you to look at it, if that makes sense. Sorry that I've been looking around and I lost my train of thought. Like 40 people just walked into the office space I'm in. All right, but here's a visual. So as you can see, right, this is just at the money. This is the stock, right? You can see it peaks just like Gamma does. We can use that to our advantage. This is why I say if you're a new trader and you're trying to actually make money, and I'm not talking, when I say make money, I'm not talking about like, oh, just make $100, oh, just make, 150, 200. No, I'm talking about making money, like putting commas in your returns at the money plays. That's how it's going to happen. You play something that's a little bit out of the money or sitting right there at the money. So that way, when that Vega, that Gamma, that large delta all hit at the same time and you're correct on your directional assumption and the stock moves for $10, you make $3,000 off of your trades, off of all your contracts. We're not trying to go small ball. If you want to go small ball, play out of the money and then just take the little crumbs that are given to you. No shame in that game. A bag is a bag, no matter how small it is. But what I'm saying is the people that are making good returns, they're not doing it necessarily unless they're putting up a huge amount of money in out of the money contracts, which is very risky. They're doing it by buying something that moves from at the money to in the money, because that's how your delta gets largest. And finally, we have Rho, the forgotten. Rho is the most neglected of all of the Greeks. It's simply a measure of the adjusted amount of the contract's price relative to the interest rate. Okay, so your knowledge of interest rates can really be zero and you'll be fine for now. But what I would suggest is that you do a little bit of research on interest rates and how the Fed is going to taper and all of those good things, because it's going to help you understand whenever that moment does happen, how Rho affects your option contract. But Rho isn't really important day to day in the ways that delta, gamma, theta, and vega are. So everything that you really need to know about Rho is in bullet one, full stop. So we have a quiz, and I can absolutely give it to you, but I want to know if you guys have any questions. I've already quizzed you so much throughout this. I don't want to like overstimulate you or make you, completely confused. Do you guys have any questions so far about what we've talked about? Anything at all? Because I want to make sure before we keep going, do a little bit of math, a little bit of thinking, a little bit of everything. No questions? All right, cool. All right, so practice makes perfect. So we're about to go in here and we're about to figure out the answers to these questions. So what you're going to see is there's going to be yellow arrows that will appear up over each of the, these are each representing contracts. So a yellow arrow over each contract. And from these yellow arrows that we see over each one of these will be the correct contract. Hold on, I'm going to close the door real quick, but I'm going to leave the question up there. So read that. Good night. There we go. All right. That's the one thing I don't like about being away from my home, is that I can never get a good old fashioned office with no strings attached. All right, with a 2% decrease in implied volatility, which of these contracts will lose you the most money out of all three of them? Which one? Okay, say all the way to the right. Okay, anybody else? Did I lose everybody? Okay, number three. You would be correct if you guessed number 3. You would be correct. Yeah, exactly. So the reason that we know, it doesn't have anything to do with this number up here, this implied volatility number. It has everything to do with vega. A 2% decrease in implied volatility is a 2% decrease no matter if your implied volatility is 58, 85, or 71. What matters most is this vega right here. That is the most important thing. Good job, guys. Next one, which contract has the most time to expiration and how can you tell? Right? You're just looking, you're like, what's going on with that? What is that? What is that? How do we know? What is it? Which contract has the most time to expiration and how can you tell? Okay, I got some twos. Let me see, 1 or 2 more answers. Lowest theta, it's at 2. Boom. Y'all are too good with it. Okay. Let's throw a little curveball in there. Which one is out of the money? Which one's at the money? And which one is in the money? How do you know which one is which? You can literally just put OAI, AIO, whatever. 3, 2, 1. Okay. 3 is at the money. Okay. All right, so here's what we got. First one is out of the money. How do I say it's out of the money? Because our delta is 0.28. That's closer to 0 than it is to 1, right? Here we go. In the money, this is 0.85. That is definitely closer to 1 than it is to 0. And at the money, 0.55 is closer for sure to being smack dab in the middle than it is to one side or to the other, right? So you just have to kind of, it depends, right? You have to make sure that you see relative to these other ones, which one will be where. Vega exposure is greatest blank. Therefore, contract blank is at the money. Which one? Vega exposure is greatest at one spot. Therefore, contract blank is at the money. All right, all right. And Vega exposure is greatest where? Hey, ooh, ooh. Angie came in and said, "Look, look at that, Alicia. Ooh, everybody got it. Everybody hit it. Everybody hit it. I love it. Oh, snap. Okay, so how much profit would I make on contract two, number two, if the stock price went up $2? This one is going to be tough. If you get the exact dollar amount that this is, even though I accidentally flashed it, I do that every time. It's so annoying. If you get the exact number, I will be very, very impressed. So remember the formula. Remember that formula that I told you about earlier. How much profit would I make on that contract? So let's see. I'm going to do the math. So here's the formula. Yay. Boom. Mm-mm. Mm-mm. Let me know when you got the answer. Just drop the answer. I will be so impressed. In fact, you know what? Yeah, if you get the answer correct and you drop this in here, I'm gonna give you my course for free. First person to get the answer right. If you want it. It goes over the Greeks. And then also, not only do you have to get the answer right, but I also want to see the formula. Show me your work. Show me your work. If you already dropped the answer, you're still in the running. Just show me what the formula was that you used. Hey, now. All right, let's see if you're correct. Let's see who got it. Oh, 171.22. Yes, 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 yes. Blazer got a hand raised. What's up, bro? You can unmute or you can talk to me in the chat, whatever you want to do. So we got 171.22. Looks like Jonathan. Jonathan, you take number one. So I'm going to write your name down, Jonathan. And you know what? Hit me up. I'm going to give you Options Olympus for free. It's my best selling course. It's the one that's made people the most money. And it all goes over the Greeks and using standard deviation. So I think that is very, very, very impressive, and you deserve to be rewarded for your hard work. Everybody else, though, y'all did phenomenal. I saw it come through. I definitely saw. Good job, y'all. Fantastic job. So, which of these contracts would lose the most money from a $1 decrease in the stock's share price? Which one would lose you the most money? How do you figure that out, right? Which one is going to lose you the most money based off of a $1 decrease? Okay, I see number one, I see number three. I see number one, gonna lose you the most money. I see number two. Oh my, this is pretty, you're right down the middle, huh? Okay, okay. I see some more one action. Number two, Amanda. Yes, yes, Amanda. Oh, it's good to see you in here. Oh, so yes, it is number two. Amanda is correct. And the reason that Amanda is correct is because remember, if the stock goes down, that first dollar, that's all delta. The second dollar and every dollar moving forward is when you start factoring in gamma. But that first dollar, you're losing your delta. So which of these deltas is the largest? The in the money contract. In the money positions will lose the most money if they're incorrect because their delta is so large. That is the main thing that we need to keep in mind. All right, so we're doing some pretty good so far. Not too shabby. I think everybody's rocking with an A so far in my book. So now the yellow arrow is over contract number one and contract number three. Which of these contracts would lose the most money from a $2 decrease in the stock's share price? Which one of them would do it? Okay, okay. Why? Okay. Absolutely correct. Ebony, you are on fire. You need to buy a lottery ticket. You're on fire. In fuego. All right, last but not least. Actually, no, we still got two more questions left. Which contract would be best to swing through earnings and why? Contract number three. Okay. It's an interesting answer. Interesting answer. Number two. Some people say two. Okay, okay. Lowest Vega. God, Amanda, it's great having you in here, man. It's really great. Yes, you will be correct about talking about low Vega, right? Vega exposure is important to have as little Vega exposure as possible whenever you are trying to swing through earnings. So if that's not a hint, then I don't know what is. Which contract is it? Number two. Bada boom. It's got the lowest Vega. You see that? So this Vega for contract three is 1975. Contract one has a Vega of 614. And contract number two in the middle has a Vega of $1.54. The reason why it would be safest is because it has the least exposure. Because remember, implied volatility collapses after earnings. Well, what if all of these, the implied volatility went down 10%? You're losing here $60 bare minimum, right? Closer actually to like $62. Here, you're losing maybe $14 or so. And here, you're losing what, 20 and 10? That's two hundo. You hate to see it, right? Like you're getting pretty close. So that's why you want to, sorry, you want to lose as little money as possible whenever you are swinging through earnings. Sorry about my foot on this chair. All right, between contracts one and two, which contract would gain the most value from an increased interest rate? Super simple, super easy. You should be able to get this in 2 seconds. Boom, love it, love it, love it. Yep, love it. Fantastic. You guys are great. So now we have come to the end of the Greeks lecture, guys. You now understand, this is just a rundown here. Let me collapse my beautiful face for a moment. You have now seen a rundown in its entirety of what the Greeks do. Delta dollars and gamma gains, the two price contingent Greeks. Theta time decay, right? The time contingent Greek. Vega volatility, the implied volatility Greek. Rho with interest rates, right? Rho rates. So you now have an understanding of how to read through option contracts, right? You now have the power to look and see what makes sense versus what does not whenever you're going and you're trying to get into a position. So what I need from you right now, swap it. All right, here we go. So what I need from you is to take a picture, a screenshot of the screen in 3 seconds whenever I tell you to, and post this to your Instagram story if it's real. And if you do and you've sent me a question and try to get a discount coupon for my content, I'll put an extra discount on top of it because I really appreciate the exposure. I want to get as many people to see this free boot camp as possible. So you ready? I'm gonna give you a chance to get the picture. You ready? 3, 2, 1. Hey, hopefully you took it. If you didn't, you missed it. No, I'm just playing. You ready? Hey, show them, show them, show them. Everybody's got to know this stuff. It's important. So, without any further ado, I'm actually going to stop the share and we're going to talk about any questions that you have so far surrounding the Greeks because I know we talked about a whole lot and I know that there's, still questions. Somebody has questions. Somebody got something they want to learn. So, I am here to try to, how do I say? I'm here to try to answer those questions and to remove any stress or doubts surrounding actually trading. So what is it that I can do for you to make it make sense? I was too slow. Oh, you need the picture? You're too slow. All right, here, hold on. I'm gonna show you the opening screen from my my other course. Hold on. In the meantime, type your questions out. I'd love to answer them. This is the actual slideshow that's featured in my course. The slideshow you just went over is based off of that. This is what's in Options Olympus. All right, you ready? We're gonna swap the view. All right, you ready? Here we go. 3, 2, 1. Perfect. All right, hopefully you got it. Hopefully you got it. This is the sauce right here. This is the sauce. You see the Heaven's Gate? You know what it is. So when it comes to the Greeks, something that you should know is that as your position gets pushed deeper into the money, as your position is pushed further out of the money, the risk reward or how you should be looking at that position, it's going to change, guys. Your risk reward is dependent upon a few things, but think about it, right? If your delta, if you need the stock to move in the direction that you want, right, in order for your delta to pay you, you're not going to buy calls near a resistance level, right, where price is going to reject and start coming back down. You're going to buy your calls off of the bounce on a support level when there's a resistance level way up here, because you can travel this whole distance before there's any reversal of trend, right? You don't buy them right here. You buy them when it breaks there and there's another level of resistance even higher than that, but you don't want to buy them at the wrong time. That's detrimental. This is what I want you to be able to understand. We can now look at a contract. We can say, oh, okay, it's nice and liquid, right? There's people that are trading it. The delta is 0.4567, right? 45.67% chance of it making it in the money. And it's got a week worth of time on it. It's a weekly contract. From that, understanding just that, you can now go out and you can make a successful trade. You now know the odds. You now know the risk reward. So, right? So if you bought it whenever the delta was 0.4567 and the stock moves against you, and now your delta is 0.3000, you've now lost 15% of your probability of making it into the money. And if you see that, oh man, we're falling through support levels and we're just going to keep going and going, it would make sense to cut the position now, right? It would make sense because your risk reward is off, and you now know that you can cut your position. You didn't use a percentage gain or loss. You used knowledge. You used the things that make that percentage gain or loss happen, right? People say, oh, should I cut I should take profit at 30% and I should take the loss at 30%. No, take the loss after it fails through a support level or a technical level. Take the gain whenever it's done running. Let your runners run. The reason they say that is because if you get to a resistance level and you break through that resistance level and keep going, would you feel satisfied taking a position at 30% whenever it went for 10,000% and you could have turned $50 into $480,000, right? Something crazy, something insane. Like if you could have turned a $10,000 investment into 400 bands, you would be like, I'm the biggest idiot. I took 10K and made it into 13, but I could have made it into, 80. You're going to feel really dumb. So instead of feeling dumb, use your technical levels and make that the basis off of why you enter and exit from a trade. Okay. That's the main things that I need you guys to be able to understand tonight. Oh, thanks, Amanda. I appreciate you. Is there something though, like I've been rambling a lot, I've been talking a lot, and I feel like I haven't given the floor to you guys. So if you guys want to unmute yourselves, if you want to come on here or do whatever, I would be more than happy to answer your questions. But for the sake of saving time and for the sake of the people that are listening to this recording, I'm going to end the recording so you can ask your questions off the record, all right? You guys be easy. I will see you next week, and that will be the final week of actual learning. And then we got a Q&A session the week after that, and you guys have made it 6 weeks with me at that point. That's amazing. So I'll see you guys around, and until the next time, all right?